When I joined in 2006, we had about 100 million in CLO debt under management. And if I look at it today, we're up to 12 billion in CLO assets on both debt and equity. I've been involved in CLOs since really the inception of the market in the 1990s. My time at Fitch, I would say, was very formative in terms of how I think about investing in the asset class. Part of it has to do with going through a pretty deep credit cycle while I was there in terms of the 01 to 03 default cycle, but also understanding each aspect of the risks of CLOs from a rating agency perspective. I think there are a lot of different ways for investors to use CLOs. Number one, it's an over $1 trillion outstanding market. It's the largest floating rate asset class for investors to access. The majority of what we have to invest in is fixed rate opportunities, and I think floaters, by their nature, offer diversification in portfolios. So I think its starting point is it's an interesting diversifier for portfolios, and then you layer on you can access risk in different ways in CLOs, meaning there's low risk tranches in the senior tranches that you can access as a proxy for, say, investment grade type risk comparable to investment grade corporates. And then there's, the bottom part of the capital structure, whether it's triple Bs, double Bs, or equity, where you're taking much greater risk and there's much greater return potential, where you can comp it to either equities or high yields. One of the things I think is super interesting also about CLOs is that you do get paid a liquidity premium and you also get paid a complexity premium. The asset class itself is pretty heterogeneous and no one deal is the same as the next, and so you're being compensated for the complexity, and then you're also being compensated for who's managing that portfolio and the risk that they've taken in the underlying pool. I think CLO equity is a misunderstood and probably a pretty inefficient asset class. It's certainly not without risk. There's very high mark-to-market volatility. In periods of risk off, you can see meaningful drawdowns in the asset class. Most important to me and what I've taken forward in my career is how important managers are within the CLO structure. There's statistics that we look at that would say that there's as much as 12% dispersion in returns across the manager cohort. You're investing with a manager who's going to make investment decisions over the life of the transaction, and their ability to mitigate defaults and avoid downgrades in the structure is pretty key to their ability to deliver CLO equity returns.